Today, on the HopeFilled Financial Podcast, we're going to be reviewing an article that goes over 6 financial military benefits for service members and veterans. This article is by U.S. News, and we're going to find out, going through it together today, whether or not all of these benefits are genuinely helpful to those who have served our country. And to get us warmed up, I'm going to tell you about a time I refinanced a condo in Utah. Please stick around to hear about all of the 6 benefits in the article, especially if you are serving or served in the military. Good morning and welcome to the HopeFilled Financial Podcast. My name is Jay Disberger, your one and only HopeFilled Financial Coach, and I'm happy that you're here with us today. This past weekend was Veterans Day, so to get things started, if you're listening and you served in the military or are actively serving in the military, no matter what branch, I want to thank you for providing us with the freedom that we cherish in this country. Thank you. And if you are associated with the military, today's episode is for you. And even if you're not, you probably know someone who has served the country, and the information here within can be very helpful to share with them. So if you don't listen through to the main topic, please consider sharing this episode with those you know who are associated with the military. I sincerely appreciate it. Now, for everybody, I have a story to tell you. I lived in Utah and I lived in a condo. I mentioned it last week when I was discussing grocery stores and reacting to the food theory episode. But I owned this condo. I had a mortgage on it. I was not renting. I owned it. And when I got the mortgage for it initially, I was following the Dave Ramsey rules, so I didn't have a credit card. I didn't have a credit history. I made it through college without student loans. It was hard, but I did it. The consequence of that is I needed to pursue manual underwriting, and I was in the position where manual underwriting does not work. I didn't have any work history. I was a college kid. I had college jobs. I paid through school with those jobs and not much else. It wasn't the kind of job history that shows that I could pay for the mortgage I was trying to get. And none of my past work history was really paralleled to my new career. I had just signed on for the job, so I had proof that I was going to be employed and when I was going to start getting my paycheck, but that was it. I had a letter from the company, nothing else. The signed acceptance letter was not enough for me to pursue manual underwriting successfully. I even called Churchill Mortgage, who is sponsoring Dave Ramsey's show, and is the mortgage company that Dave Ramsey drives people to for manual underwriting. And they told me that I needed a credit score to get a mortgage. And I know that some of Dave's advice here would be to rent for a duration of time, build up that history so that you get the manual underwriting, but I was impatient. I knew that the Salt Lake market, the real estate market there and the surrounding areas was hot. And I didn't want to deal with rent going up or down. And I felt pretty confident I was going to stay there for around 5 years. It ended up being 4, but, I still came out on top. I was bound and determined to own right out instead of renting because renting was also, month to month, more expensive than having a mortgage, even if I didn't get a very good rate on the mortgage. And this was the window that opened up my world into credit cards. So I did get credit cards. I established a credit history and was able to get a mortgage, but my credit history wasn't very long, so the rate I got on the mortgage for the time was not very good. It was a little over 5%. Keep in mind, this is before the plague and the severe drop in lending rates that occurred during that time. So with that in mind, I got a mortgage. I think it was for $175,000, $185,000, and I want to say 5.25% on the interest rate. My plan wasn't to keep this particular mortgage forever. I wanted to wait for rates to drop, and I wanted to wait for some of my history for paying on the mortgage to show up on my credit score, have a higher credit score, and refinance. And I probably waited too long to refinance. I probably could have done it a year earlier. It was sort of hard to know, but I did refinance when rates were really close to 2%. So I was able to get a good rate, even though I had trashed and cut up my credit cards at this point. So all of the credit card history that I have is gone. The only thing that is active on my credit report is my mortgage. And my payment history primarily was based on the mortgage. I still had over 750, 770 for my credit score. It was insane. So when I went to go refinance, getting a good rate was not a problem. Now, this is the question I want you to ask yourself if you ever consider a refinance. I know it's less likely with the higher interest rates right now, but if you're wanting to refinance and go to a lower rate, you need to ask yourself, what is my break-even period of time? Because when you refinance, you're going to experience closing costs again, just like when you bought the home. And those closing costs are not cheap. So when you refinance, you're going to see, hopefully, if you get a better rate, a reduction in how much of each mortgage payment is going toward interest and an increase of how much each mortgage payment is going to principal. And on the whole, if your time to pay off the mortgage is about the same as your initial one, so say you had a 30, you have the home for 10 years, and you refinance with the 20, you keep that end date the same. Well, your mortgage payment should be a little lower only because of the lower interest rate. Now, you're not calculating the difference between your previous mortgage payments. You're calculating the difference between the interest payments that you had. So you're comparing the interest rates, payment to payment, month to month, down the line, and you're adding up the savings between the interests until the cumulative savings is equal to the closing costs you'll experience from refinancing. When you hit that point, that's the break-even point. That is when your refinancing has paid for itself. It has saved you that much money, and that savings has been applied to the equity in your home. For me, because I went from 5.25% all the way down to almost 2%, I did the break-even analysis, and it was less than 2 months. I would have been foolish not to refinance the home. Break-even period of 2 months is unheard of, at least in the refinancing world. I couldn't believe my luck when I saw that. So naturally, when I saw that, I refinanced in a heartbeat, and I was very happy to have done so. The refinancing was able to help me build equity significantly faster than I otherwise would have, and really helped line the equity in the condo so that I could afford the down payment on my current home here. And I didn't need to have credit cards or any other loan history other than just paying the mortgage on the condo, the original one and the refinanced one, in order to qualify for a healthy mortgage on this home. I got this home right before rates started to get a little crazier, and I'm hoping that rates will drop below my current rate eventually, and I might be able to refinance again. But there is a warning I need to give you. If you refinance for the sake of refinancing and you kick your payoff period down the road over and over, you might be pushing the payoff date of your mortgage past retirement age. And if you don't plan or don't think you're going to be able to put anything extra toward the mortgage in order to move that date up, you risk running into retirement age and still having a mortgage. When we retire, it's going to be significantly advantageous to have our homes paid for. That way we can remove the biggest bill that is consuming our income right now. The mortgage, living expenses, rent, whatever you're doing to put a roof over your head. If it's gone, you don't need near the income you have now when you retire to maintain your standard of living. And that means you can either retire earlier or not have to save up quite as much in order to retire with dignity. Now let's move into today's main topic, the review of the U.S. News article about 6 financial benefits for military service members and veterans. About a year ago, when I started planning the HopeFilled Financial Podcast, I saw this article and it piqued my interest, and I specifically planned it for the episode following Veterans Day because I have friends and family members who have been in the military. And going through this article back then, there were some benefits that struck me as inappropriate or maybe even being a disadvantage to those who have served our country. So I wanted to go through the article and just give you my 2 cents on it. Again, this is an article from U.S. News, and the article is entitled 6 Financial Military Benefits for Service Members and Veterans. To get started, there's a picture of a happy family here working on the computer, and I'm just going to start by reading the little introduction here. If you serve in the military or have served in the past, you have access to special financial benefits for yourself and your family. And new rules make these programs even more valuable, but most people don't make the most of these important financial perks and may not even realize if they are eligible. The following strategies can help you take advantage of special military benefits to save for the future. I'm all about saving. Protect your income, pay for college for yourself and your kids, save money on mortgages, reduce the interest rates on your debt, and make the most of legal protections for the military. Next, they give a little roadmap for the 6 benefits they cover in the article. These are new rules for retirement savings. Okay, that'll be interesting. This article is only 2-3 years old, so the rules are probably still applicable. Speaking of, I want to do an episode on the Secured Act 2.0. That changed a lot, especially if you have children. Don't forget to subscribe if you don't want to miss it, or follow if the platform you have doesn't have a subscribe but a follow. The second point they have is guaranteed 10% interest for deployed service members. That's interesting. Third, lower life insurance cost. That's great. Fourth, longer-term education benefits for you and your family. I'm interested to learn about those. I don't remember the details. 5, larger mortgages with no down payments. Ooh, that can backfire. We'll talk about it. And number 6, legal protections for service members. With that, let's scroll down in the article and keep reading. Members of the military have access to one of the lowest cost ways to save for retirement, the Thrift Savings Plan, and new rules make the TSP even better. You can now contribute up to $19,500 to the TSP in 2020, or $26,000 if 50 or older, or up to $57,000 if you're receiving tax-free income in a combat zone. Now, these numbers have probably gone up. I know that $19,500 was the limit for 401k contributions, and it's been raised since this article, so be sure you keep up to date with current tax law for limits on your applicable retirement accounts. The TSP never provided an employer match for service members in the past, but that changed in 2018. People who joined the military in 2018 or later, or who joined from 2006 to 2018 and opted into the blended retirement system, can now get matching contributions from the Department of Defense. That's cool. To get the full match, you'll need to contribute 5% of your income to the TSP. That's free money. And the TSP can still be valuable even to save if you aren't in the blended retirement system and don't get the match. It's such a well-managed, low-cost way to save for retirement, says Ted, a retired Navy captain and executive director of the American College of Financial Services Penn Mutual Center for Veterans Affairs. Ooh, a mouthful. Everyone on active duty should consider putting money aside in the TSP. Getting a match is a big benefit. I'm very happy that the Department of Defense now offers this to our service members. You can either make tax-deductible contributions to the TSP, which grow tax-deferred and are taxable when withdrawn, or you can make Roth TSP contributions, which don't reduce your taxable income now, but can be withdrawn tax-free in retirement. Many long-term service members don't realize they're eligible to make Roth contributions, which became an option in 2012. I was on a 401k based meeting not too long ago, and the option for Roth 401k came up in that meeting, and it was asked to those who were in attendance, which is better, to go Roth or traditional with the 401k? And I mentioned that it might make sense if you're later on in life, if you have a low tax rate right now, to make tax-deferred or traditional contributions instead of Roth, as long as you're not worried about required minimum distributions or not worried about leaving a taxable asset to your heirs. When you have a Roth account and you pass away and you leave it to someone, they inherit it, it becomes an inherited Roth IRA. It can grow tax-free for 10 years, and there's no required minimum distribution that is imposed on those who survive you. And the answer I got in that particular meeting was that Roth is probably the default that everyone should consider. And yes, while running the numbers and an individual's particular goals may make it more advantageous to go traditional, the guy who was given the presentation said you should default to Roth and not default to traditional. Treat traditional as the option that once you get really technical, you pursue, given a positive net benefit to you or those who survive you. With that, let's move back into the article. I strongly feel that our service members should consider the Roth, says Ted. You pay the tax now, but you'll be thankful in the future because most people on active duty are in a lower tax bracket now than they will be later. That's a good point. And all of that growth will be tax-free. Unlike Roth IRAs, there's no income limit to be able to make Roth TSP contributions. That's a huge benefit. And I would strongly encourage anyone who has access to a TSP account to pursue taking advantage of it. You can choose from 6 investing options in your TSP, including funds that invest in large or small companies, international companies, bonds, government securities, or a life cycle fund that creates a diversified portfolio based on your investing time frame. That sounds like a target date fund. I haven't talked about those too much on the podcast, but I'm not as fond of them for most people. Some of the most common missteps I see are people not contributing to their TSP at all, not contributing enough to get the full match, or leaving all their money in the G fund, which is the most conservative one, says Shay, Financial Readiness Manager for the FINRA, Investor Education Foundation. The G fund invests in government securities and has the lowest risk, but misses out on the long-term growth potential from stock funds. When they say risk here, they're talking about the amount of volatility, the propensity for a fund's value to go up and down. In the long run, if you're in something that is quote unquote lower risk or more conservative, it may actually be a greater risk to you, as it hampers your overall growth and can prevent you from saving enough or having enough invested to retire with dignity. So let's be careful when they say risk here. They replace risk with volatility, not necessarily risk. You need to consider risk in your personal situation and consider risk tolerance as volatility tolerance in addition to the risk of having enough. I hope that was clear. We'll cover it again later. Again, subscribe if you don't want to miss that. Getting back to the article, it says, Shay tends to prefer the life cycle fund, L fund, which is a target date fund. Aha, I knew it, target date fund, with a portfolio based on your investing time frame. The L fund starts out with most of the money in stock funds when you're young and gradually becomes more conservative when you get older and closer to retirement. The TSP recently changed its rules to provide more L fund options. You choose the fund with the date closest to the time you plan to start withdrawing the money in retirement, which may be much later than the year you actually retire from the military if you take a civilian job before you stop working. In the past, the TSP only offered L funds in 10-year increments, such as L2050, L2040, L2030, and L2020, which could make it difficult to match the fund with your time frame. Starting in July 1st, 2020, you now have L fund choices for every 5 years. I like that. I think that's an overall improvement. A 10-year gap picking if you were in the middle would be difficult. Continuing on, the TSP withdrawal options were also changed recently. In the past, the withdrawal rules for TSPs were much more limited than they are for 401ks and other retirement savings plans. After taking one particular withdrawal, you either had to cash out the entire account or convert the money to an income stream. Like, I'm guessing that means like an annuity or something. Many people would roll their TSP in an IRA when nearing retirement to have more flexible options. That sounds advantageous given the limitations. But the rule changed in September 2019 to make TSP withdrawals more flexible, eliminating the restrictions on partial withdrawals and making the withdrawal choices much more like 401ks. I think that's great unless they added some more of the loopholes that exist in a 401k that allow you to withdraw money from your retirement plan early for particular given reasons. I think one for IRAs is, and don't quote me on this, I might be misremembering, is pulling money out for a first-time home purchase. I, in general, disagree with that as a move because the money you put aside in retirement should be dedicated toward your retirement. The time value that it has in there and the propensity to grow is going to significantly outweigh the benefit of adding a little extra chunk to your first home's down payment in general. Let's continue here to the second benefit. That wrapped up the first one. The first one being the retirement options you have through the TSP if you served. The second one is guaranteed 10% interest for deployed service members. Begins saying, service members who are deployed to a combat zone can contribute to the savings deposit program, which sounds too good to be true. You can deposit up to $10,000 in this account while you're deployed, and for up to 90 days after you return, which earns 10% annual interest. Wow. Patrick, a retired Marines helicopter pilot who is now a certified financial planner in Springfield, Virginia, has worked with several young service members who knew they were being deployed to the Persian Gulf within a year and worked toward building up 10,000 in savings so they could take advantage of the maximum investment in this program. The procedure to get started is tricky because you have to deposit the money by cash, check, or through allotment after you are deployed. The finance office in theater can help you set up the account. See the savings deposit program fact sheets for more information. There's a link you can click there. Normally I say don't click there, but I think that's one that you would want to click. Okay, let's talk about this for a minute. If you are at the point where you don't have any debt, you are on track for retirement, and I'm assuming this is guaranteed 10% in a brokerage type account or a taxable account. I wouldn't pass that up. Guaranteed 10%, that just doesn't exist. I mean, the closest thing you're going to get is a match, and the match that they had was 5%, and that's probably a percentage of 5% of your income you're putting toward it. But this 10% on 10 grand, well, I mean, that's awesome. Okay, next we're going to talk about number 3, which is lower life insurance costs. Members of the military have access to low life insurance through Service Members Group Life Insurance, or SGLI, and the premiums were reduced even more in July of 2019. You can now get up to $400,000 of life insurance for 6 cents per month per $1,000 of coverage, bringing the annual premiums for the maximum coverage down from $336 to $288. These premiums apply regardless of your health and risk. See the VA's life insurance page for details. I think that's downright fascinating. They said regardless of your health or risk, which I almost interpret as regardless of age, but I don't know. Service members can also get up to $100,000 of coverage for their spouses, with premiums of $54 per year for spouses under age 35 and higher for older spouses. Yeah, typically term life insurance gets more expensive as you get older, so that makes sense. You can only keep SGLI while you're in the military, but after you leave, you can sign up for Veterans Group Life Insurance. The premiums for this coverage are much higher and increase as you get older. It's a good idea to compare the costs to buying coverage on your own before you leave the military. If you're healthy, you may find a better deal with private insurance, but VGLI can be a good option if you have health issues. See the VGLI page for eligibility and deadlines. So when it comes to the life insurance stuff, if you do have a health issue, or say you're deployed and you get injured, and it makes it so that a private insurance would consider you, quote unquote, uninsurable for life insurance, this is a solid benefit. You're putting your life on the line. You're putting your health on the line when you serve our country and you get out there and you fight for our freedom. And I love that this benefit prevents you from feeling like you're going to lose qualification to a healthy life insurance policy that defers risk that you can't afford to take on yourself if something were to happen to you. That way you know your loved ones who depend on you are going to be taken care of. That was absolutely brilliant. Let's move on to the next one, which is long-term education benefits for you and your family. So far, I've loved all of these. The post-911 GI Bill covers the full cost of in-state tuition and fees at public colleges for up to 36 months, or up to $25,162 for the 2020-2021 school year for private colleges. I'm sure that number is higher now. It also provides money for books and supplies, and you can receive a housing allowance if you attend school more than half time. That's cool. You can use the money for undergraduate and graduate degrees, vocational and technical training, and other eligible programs. Use the GI Bill comparison tool to look up eligible schools and estimated benefits. And there's another link there. You can find this article in the description below, and if this is something you're interested in, definitely click there. There is impressive flexibility in the way you're able to use the GI Bill benefits, says Diddy, a retired Navy intelligence officer who is now a certified financial planner in Virginia. A few years after leaving the military, she used her GI Bill benefits to pay for a financial planning certificate program at Georgetown University. She says that having the GI Bill benefit can also be timely for veterans who have lost their jobs this year. Former or retired service members who may have lost a job due to economic upheaval, and here the article references the pandemic of the time when it was written, well, they may be able to train in a different career field or take a couple of refresher courses to strengthen their resume as they begin applying for jobs again. To qualify for the maximum benefits, you must serve for at least 36 months on active duty, or less if you were discharged for a service-connected disability. Service members and veterans originally had to use their post-9/11 GI Bill benefits within 15 years of leaving service. However, the 2017 Forever GI Bill eliminated this time limit for people whose service ended in 2013 or later. See the VA's post-9/11 GI Bill page for more information. Longtime service members get a specific benefit. They can transfer their post-9/11 GI Bill benefit to their spouse or children. To qualify to transfer your benefit, you generally must have served for at least 6 years and agree to serve for 4 more. Spouses can use the transferred benefits right away, but children must wait until you've served at least 10 years. Children must use the benefit before age 26. For more information, see the VA's Transfer Your Post-9/11 GI Bill Benefit Guide. Well, that is incredible. I think it's awesome that the benefit here now can apply indefinitely to the service member after they are no longer serving in the military, and that under certain circumstances, you could transfer that benefit to a spouse or a child. If you naturally fit into the restrictions that they had there, wow, I mean, being able to gift that much of an educational benefit to a child is huge. That's really cool. I think one of the best things we can do is invest in ourselves and invest in our education. And what a gift to be able to do that for your child and remove the burden of what may otherwise become a horrible student loan that's non-bankruptable. Speaking of children, this last paragraph here for this benefit says, also, many colleges participate in the Yellow Ribbon Program, which provides scholarships to help supplement GI Bill benefits for out-of-state or private colleges with tuition above the maximum limit. The Yellow Ribbon Program is currently available only to veterans and to children who are using transferred benefits, but will be extended to active duty service members and spouses starting in August 1st, 2022. So that's supposedly been active for a little over a year. That's very cool. The specifics vary by school. See the VA's Yellow Ribbon Program page for more information. Now, personally, while this helps someone if they wanted to go out of state or go to a private school, I don't think it's quite necessary depending on what you want to study. The general advice that I would give to anyone, regardless if they're a veteran or not, would be to consider your higher education at a local in-state school. And if you don't have big scholarships that can drop the cost on that or benefits that can drop the cost going there, consider a community college for the prerequisites if you save money. Most people don't have a correlation to the job they get in the school they go to. So it's going to be most frugal and efficient for you to choose an in-state school, even if the benefit can be transferred to an out-of-state or private college. This is especially true if going to the out-of-state school or the private college is going to result in student loans that expose you to undue risk. Let's move on to the next point in the article. This is the smallest one I've seen so far. It says larger mortgages with no down payments. VA loans have a long history of providing competitive mortgage rates for service members and veterans and enable them to buy a house with no down payment without having to buy private mortgage insurance. The size of the maximum VA loan has increased significantly in the past several years. See the VA's Purchase Loan page for more information. If you have a service-connected disability, you may not have to pay the VA funding fee. If you already have a VA loan, you may be able to lower your mortgage rate with an interest rate reduction refinance loan, says Shay. Okay, this is the first benefit on here that I have a little bit of a problem. Imagine you go, regardless of your background, and you get a mortgage, and you somehow are able to put no money down on it, be it through the VA loan program here or some other magic that I don't know about. You buy the home. You buy at the peak of the housing market, and then the housing market sees a 5-year lull. It drops sharply, and it doesn't come back to the previous value for the next 5 years. Well, during that time, if you buy it and the value drops, you are now upside down on the home. If you wanted to sell the house, you're going to be liable to pay the difference from what you sold the home for and what you owe on it. When you're upside down, that can trap you in a place, in a home that for some reason you don't want to or cannot stay in any longer. And if you're in a position where you're not putting a down payment on a home, you probably don't have the savings to recoup the difference. So you just simply don't ever sell the home, even if you discover mold in it, even if you discover a major problem. This particular benefit here allows you to engage with a housing situation that can become a complete nightmare that you have no control over. If you have fair equity in the home or are able to build up good solid equity with a small down payment to get in, well, you have a buffer for when the market drops so that you don't end up upside down on the home. I know those of us who lived through the 2008 housing crash saw it happen multiple times over in our personal circles. We saw people's homes go upside down so that it was almost impossible for them to get out from under it. And if they had an adjustable rate mortgage, they didn't say anything about it here, but if a VA loan comes with the option to have an arm on it, that I think is even scarier because then your mortgage payment can change. Imagine you go upside down on the house, then the adjustable rate kicks in, the payment becomes more than you can afford. Now you can't make your mortgage payments on a home that you can't sell without trying to come up with tens of thousands of dollars. I think that sounds like a complete nightmare. So even if the VA loan allows you to buy a home without a down payment, I would strongly discourage pursuing that. I would say still come in with a good, healthy down payment. Come in with the payment as if you didn't have the VA option here. And if the interest rate is lower than what you could get on a traditional mortgage, then jump on it. And if the traditional mortgage, again, not counting ARMs, I do not like adjustable rate mortgages. If you're able to get a lower rate on a traditional mortgage versus the VA mortgage, then I would definitely go with the traditional mortgage over the VA loan, even though it's custom tailored to you who have served in the military or are actively serving. I think there are some reasons why you might use a VA loan to buy a house, but for the particular benefit that they highlighted there, I find it more scary than helpful. Let's move on to the next one. I think this is the last one. Legal protections for service members. The Service Members Civil Relief Act, or SCRA, provides valuable legal protections for service members. Most important is the 6% interest rate cap for loans taken out prior to military service, including mortgages. Ooh. Credit cards, car loans, student loans, home equity lines of credit, and business loans. The cap only applies to loans you took out before you were on active duty, so it can be particularly helpful for a new service member. New service members who had high interest loans before they joined the service or members of the reserves who are called to active duty. The rate is reduced to 6% while you are on active duty, not just delayed. You need to contact your lender to get the loan rate reduced, but the procedure is usually simple. Most lenders have an SCRA form to submit along with your military orders. Navy Federal Credit Union, for example, has an SCRA page and benefits request form. The SCRA also gives you the right to terminate a residential lease if you receive permanent change of station orders, or if you receive orders to deploy for 90 days or more. You can terminate a car lease in several circumstances. such as if you receive orders to deploy for 180 days or longer. These lease termination provisions helped a lot of military families whose plans were changed earlier this year because of stop-move orders. Well, this benefit here, I think, can be very helpful in today's extra high interest rate environment, as we've been struggling with very high inflation and higher mortgage rates. If you have one of the higher rate loans or a high student loan or credit cards are a big one. If you have a big credit card balance and you end up going active to serve the country in our military, well, being able to reduce those interest rates down to 6% is incredible. That's an opportunity that can help you reduce how much of your paycheck, your hard-earned money, is going to interest and not gaining you any ground and getting rid of debt. I'm not a fan of debt, and I'm not a proponent of going out and getting a loan, a risky loan at that, so you can take advantage of this. I'm looking at this as a nice way to say, this is going to be an undue financial strain on you if you have to pay crazy interest rates on these loans. You're going out to serve. You're going to be spending a lot of time away from family, from our country, from loved ones, from friends. While I think this is a nice benefit, it's the least that can be done as a thank you. And if I were in a situation where I had a high interest loan and I wound up deployed, I would take advantage of this benefit in order to help expedite the getting out of debt process using the debt snowball. If you're not familiar with the debt snowball, I covered that in a previous episode of the HopeFilled Financial Podcast. We'll pop a link in the description. And I think that wraps it up for today. If you know of any other benefits for military service members or veterans that wasn't covered in this article, or changes that have happened since this article was written, please let me know about them in the comments below. I might be able to do a follow-up episode next year for Veterans Day covering new changes or benefits that really should have been highlighted in this article and weren't. And if you haven't already, like, follow, share, or subscribe. Next week's episode, I'm going to be going back to Dave Ramsey is Wrong and following up on what has transpired since I posted the most popular episode of the HopeFilled Financial Podcast. Until then, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.